What if the Federal Reserve just admitted its entire game plan from the last 5 years was built for a world that no longer exists? Because that's exactly what's happening. The Fed has been operating on a playbook it wrote back in 2020, a playbook designed to fight a ghost, the ghost of low inflation. But we all know what happened next. A tidal wave of real inflation crashed the party, and the Fed was caught completely flat-footed. Well, they just dropped a series of internal papers that basically act as a roadmap for their new playbook. And let me tell you, it signals a major shift in how they think about the economy, interest rates, and your money. Today on FedSpeak, we're breaking down this new roadmap, what it means for the Fed's next moves, and how it could impact your portfolio. Stick around. All right, everyone, welcome back. So the Fed has just concluded its big 5-year review of its monetary policy framework. Think of it as the team going back to the locker room to review the game tape after getting absolutely smoked by inflation. This new Fed's note, called A Roadmap for the Federal Reserve's 2025 Review, gives us a look at all the research their staff presented to the FOMC to figure out what went wrong and how to fix it. First, let's rewind to the last review in 2020. Back then, the big fear was that inflation was too low and that interest rates were stuck near zero, what they call the effective lower bound, or ELB. So they created a framework to deal with that. Two big ideas came out of it. One, they adopted something called Flexible Average Inflation Targeting, or FIT. The idea was to let inflation run a little hot for a while to make up for periods when it ran too cold, averaging out to 2% over time. Two, they changed their jobs mandate. Instead of reacting to deviations from maximum employment, they would only worry about shortfalls. This meant they would let the job market run as hot as possible without worrying about it causing inflation until they saw a real problem. This was the playbook, right before the pandemic sent inflation to the moon. The 2020 framework was designed for a low-inflation world, but we got the opposite. As the Fed note says, there was nothing in that framework that stopped them from acting, but it clearly wasn't designed for the fight they ended up in. So this 2025 review was all about one thing: finding a strategy that is robust, one that works in a broad range of economic conditions, whether inflation is high, low, or somewhere in between. The Fed staff presented a series of papers to the committee between January and June of 2025. Let's walk through the key findings. The first papers, from January, were basically a history lesson on the 2020 review and a look at how other foreign central banks handle these things. Then in March, they tackled the labor market. They took a hard look at that shortfalls approach from 2020, and the findings are a big deal. The research paper highlights that a strategy focused only on shortfalls, just getting people jobs, can actually lead to modestly greater inflationary pressures. It even warns that in certain situations with supply constraints, like we saw during the pandemic, this approach can give rise to rapid increases in inflation. That's a pretty direct critique of their own 2020 strategy. The third set of papers, from May, was the main event. This is where they really dug into inflation. One paper was a stunning post-mortem on why their own staff's inflation forecasts were so disastrously wrong from 2019 onward. They basically admit that their old models didn't work in the face of the pandemic's massive supply and demand shocks. Another crucial paper directly compared the 2020 strategy of FATE with a more traditional flexible inflation targeting, or FIT. And here is the key takeaway. The paper states that FATE's performance advantage over FIT is largely eliminated when you're not stuck at zero interest rates. It says the advantage also shrinks when there's a greater likelihood of inflationary shocks, which sounds a lot like the world we live in now. This is the Fed's own staff giving the FOMC an intellectual off-ramp from the average inflation targeting policy they adopted just 5 years ago. Finally, in June, the last papers looked at risk and uncertainty. The theme here is humility. The world is uncertain, shocks happen, and policymakers need a strategy that can handle surprises without breaking. All this research led to the FOMC approving a revised policy statement on August 22nd. And while we're still digesting the final statement, this roadmap of research shows us the direction of travel, away from the dovish 2020 framework and towards something far more flexible and hawkish. So, what? Okay, Dave, enough with the FedSpeak. What does this actually mean for me and my money? This is a big deal. These papers are the theoretical foundation for a major pivot at the Fed. I see three key impacts for investors. First, the Fed is developing a hawkish tilt. All the evidence in these papers points away from the policies of 2020. The critique of the shortfalls approach and the downplaying of average inflation targeting are massive signals. It means the Fed is likely to be much quicker on the trigger to fight inflation in the future. They will be less willing to risk an inflation overshoot just to squeeze out a few more jobs at the end of a cycle. Second, the era of the Fed promising to let inflation run hot is likely over. That fate strategy was basically a promise to keep rates lower for longer. The new research gives them the justification to abandon that. This means the so-called Fed put, the idea that the Fed will always step in to save markets, is probably much further out of the money. If inflation is even a little bit sticky, they will prioritize fighting it over propping up asset prices. Third, expect more volatility. The huge emphasis in these papers on uncertainty, risks, and robust strategies tells me the Fed is moving away from giving clear long-term promises. The era of "we're not even thinking about raising rates" is gone. Policy will be much more data-dependent and therefore less predictable. For investors, less predictability means more market swings as every inflation and jobs report gets scrutinized under a microscope. What now? So, based on this new roadmap from the Fed, how am I thinking about adjusting my own strategy? Now, remember, this is just how I'm processing the information for my own decisions. First, I'm taking a hard look at my exposure to long-duration assets. I'm talking about those high-flying growth and tech stocks or long-term government bonds. These assets are incredibly sensitive to interest rates. A more hawkish, less predictable Fed that's more willing to keep rates high is a direct headwind for them. Their valuations were built on a foundation of low rates forever, and that foundation is cracking. Second, I'm doubling down on true diversification. If the Fed itself is admitting the world is uncertain and is building a strategy for multiple possible outcomes, my portfolio better be ready too. This means not just diversifying across stocks and bonds, but across different economic scenarios. I'm looking at assets that can perform well if this new, more hawkish Fed has to keep rates higher for longer to tame stubborn inflation. This could include value stocks, energy, industrial sectors, and maybe even commodities or inflation-protected securities as a hedge. Finally, the word I keep coming back to from these Fed papers is robust. That's my new mantra for my portfolio. I'm stress testing everything. Can my portfolio withstand a period of higher than expected rates? Can it handle the kind of volatility that comes from a less predictable Fed? If not, it's time to make it more resilient. The Fed is preparing for a new playbook, and as investors, we need to do the same. Disclaimer. Remember, folks, this is not financial advice. All opinions are for informational and entertainment purposes only. Please consult a professional for your financial decisions.